the Retirement Savers Credit. It's a pretty powerful credit that a lot of people can use in order to help them achieve financial independence. It can substantially reduce their tax bill, especially if you're in the median income or lower tax bracket. Stay to the end of this video because I'm gonna give you a realistic example and a calculation of how the Savers Tax Credit could possibly apply to you. Now, here are some things that you definitely need to know about the Savers Credit. And the first thing that you need to know is that it is based on your adjusted gross income, or your AGI. It's not based on your total income. It's not based, your gross income. It's not based on your taxable income. It's based on your adjusted gross income. So when you're calculating the tax credit, if you're gonna qualify for it, use your adjusted gross income. Your adjusted gross income is gonna be calculated after you take your adjustments to your income, but before you take your deductions. So before you take the standard deduction or your itemized deductions, but after you take your Schedule 1 adjustments to your income. That's how you're gonna calculate your adjusted gross income. And I have another video that explains it in much more detail, the difference between the different kinds of income when it comes to tax purposes. Make sure you watch my other videos that explain adjusted gross income, that explain taxable income, and all that. The next thing that you need to know about the Savers Credit, number 2, is that almost any kind of retirement account is gonna qualify you for possibly getting the tax credit. So this can be an IRA, both a traditional and a Roth. This can be a 401k, a 403b, a 457b. There are many different kinds of retirement accounts that are going to qualify you to be able to get the Savers Tax Credit. So don't think that it just has to be an IRA or it just has to be a workplace 401k. There are many different kinds of retirement accounts that are going to qualify you for this tax credit. Now, number 3 on this list is that even if you are a student, you could still possibly get the Savers Credit, because one of the things that disqualifies you for the tax credit is typically being a full-time, college student. But there are still some ways that you can get the tax credit even if you're a student, because the way it's read is that if you're a full-time student for 5 or more calendar months within that tax year, then you're disqualified. But that doesn't mean that if you were a student at all that you're disqualified. Let's say you only took maybe your first semester of college or possibly your last semester of college, and you were only in for 1 semester in that tax year. That would mean that you were probably only in school for 4 months out of the year, and therefore theoretically you should still qualify for the credit because you weren't a student for more than 5 months out of the year, even if you were a full-time student during those 4 months. So this would apply if maybe you started college in the fall and you only did a fall semester that tax year, or let's say you finished in the spring and therefore you only did 1 semester in that tax year, which is the beginning of the year. In both cases, you could still possibly qualify for the Savers Tax Credit. Next up, the next thing you need to know is the qualified maximum contributions. So if you're single, only up to $2,000 of your contributions qualify for the credit. And if you're married filing jointly, that's $2,000 per person. So up to $4,000 of contributions can qualify for the tax credit. This is something that I always used to get confused about, or I always used to forget about, that only this amount of contributions qualify. So basically you take your adjusted gross income and you apply that to the Savers Credit chart, but only a certain percentage of the amount of contributions you make are going to qualify within that chart. Because you can either qualify for 50% of your contributions, 20% of your contributions, or 10% of your contributions. So if you take the maximum, if you're single, that's $2,000 times 50%, $2,000 times 20%, or $2,000 times 10%. And that's the amount of your credit is going to be. So assuming the maximum contributions, you qualify for it. If you qualify at the 50% rate, then you're going to get a $1,000 tax credit. So if you can somehow make it to where you fit into that 50% part, then that's going to be a huge advantage for you when it comes to tax time. And speaking of the credit itself, that means that the maximum credit that you can receive is going to be $1,000, or double that if you're married filing jointly at $2,000. That's because you take the maximum contribution amount that's eligible, which was $2,000 if you're single, and the maximum credit qualification, which is 50%, and that would be $1,000, and double that if you're married filing jointly. So the maximum credit you can either receive is going to be $1,000 or $2,000 if you're married filing jointly. Now, if you like the Retirement Savers Credit and you like this video so far, please make sure you like it and give it a thumbs up. It really does help me out, and I really do appreciate that. Plus, it's going to help spread this video to other people who need to see it. So thank you so much for hitting that like button. But now let's move on to number 6. So number 6 is that if you took a distribution from your retirement accounts, you're going to actually have to subtract that from your qualified contributions. So here's an example for that. Let's say throughout the year you put $4,000 into an IRA. all right? But it just so happened that you took out $3,000 from that IRA later that year for something that you wanted to do. Maybe you bought a house, or maybe you had an emergency and you needed to take some money out of an IRA. That would mean that your actual qualified contributions are no longer $4,000 because you took a distribution from those retirement accounts. So in this example, you take your $4,000 you originally contributed, but you took out $3,000. That leaves you with only $1,000 of qualifying contribution. So in this case, if you're going to qualify for the retirement savers credit and you took a distribution, you would only qualify based on $1,000 of contribution because you took a distribution. And speaking of contributions, if you roll over money into a retirement account, so let's say you get a new job and your old 401k, you roll it over into your IRA. Well, that rollover from your 401k into your IRA doesn't count for the retirement savers credit because that is a rollover and not a contribution. So you can't count your rollovers if you're going to calculate it for the retirement savers credit. It has to be a new contribution. It can't be a rollover. And next we have number 8, and number 8 on this list is that the savers credit is not refundable. Okay, so it's a non-refundable tax credit. And basically what that means is that if the savers credit brings your tax bill to beyond zero, so let's say you got the maximum tax credit for $1,000, but your actual tax bill would have been only $700. Well, that difference of $300, you're not going to get that refunded to you. You're not going to get paid because of the retirement savers credit. It's only just going to bring your tax bill to zero, and that's as far as it can go. It is not a refundable tax credit, so you can't get money paid back to you beyond like a negative tax bill. You can't get money paid back to you because of the savers credit. You can only possibly reduce your tax bill down to zero. That's the maximum benefit that you can get from the savers credit. So now that you know those really important facts, let's go ahead and give you an example. Now for our example, let's say that you are single and you make $50,000 per year. Okay, working in your day job. You make $50,000 per year, you want to achieve financial independence, you want to retire early, and therefore you contribute the maximum amount to your 401k. Now in 2021, the maximum amount that you can contribute to your 401k is $19,500. So if you do that while making $50,000, you're going to take your $50,000, subtract out that maximum contribution, and that should leave you with $30,500. So that's how much you have pretty much to go spend and do whatever you want and live your lifestyle. Okay, while $19,500 is going towards your early financial independence. So in this case, you're just going to get taxed on $30,500 of income instead of $50,000 of income if it's like a traditional 401k. So once you calculate your tax bill using $30,500, you're going to go ahead and see how much you can get with the savers credit. If you have no other adjustments and therefore your adjusted gross income is $30,500, you're going to qualify for 10% of your contributions up to the maximum amount. Now, as we learned earlier, the maximum amount of qualifying contributions for the savers credit is just $2,000 if you are single. So you take your $2,000 contribution, you multiply it by the amount you're eligible for, in this case it is 10%, and that's going to give you a $200 tax credit. So after your tax bill has been calculated based on that $30,500, you're going to subtract out $200 from your tax bill because that's how much the tax credit is worth. Now that is really cool that you get $200 off your tax bill just because you want to achieve financial independence and just because you're putting money towards your retirement. However, there are so many other things you can do in order to substantially reduce your federal income tax bill. And that's why if you haven't already, you need to watch another video that I created because I created a full guide to minimizing your federal income taxes and achieving financial independence by doing so. So make sure that you watch that video if you haven't already. Thank you so much for watching this video. I'm Zach from OnCashflow.com, and I hope to see you next time.